No doubt if you're watching us right now, you have spent time on social media or doing a search for the internet looking for information to either confirm or deny some set of assumptions that you've run into or
Right?
somebody has posed to you. And as we were just getting started here, I mentioned that that was actually the conversation, part of the conversation at the dinner table last night when my wife was grousing about one of her nieces who was posting stuff on Facebook that she had seen on the web and hadn't actually verified that it was true or not.
Yeah.
That's a big problem.
Yeah.
My name is Don Creech.
And I'm Perry Sykes. Welcome to the Investor Resources Podcast.
So it's easy to find information. In fact, we were looking for some health information for my wife a couple of weeks ago, and when we put the symptoms in for the search, it came back with a whole slew of possible implications, none of which were good. Which about 3 or 4 days later, when she had a meeting with her cardiologist, he went through them with her and said, none of these apply to you. They are bad, but they don't apply to you.
They're not bad for you. So that's important.
So this whole area of validation is something that our younger generation really has not been taught. Critical thinking, verify, trust but verify. And it's not taught in classes today, and certainly even on the internet, that's not a lot of encouragement to get you to go check somebody else. We're sitting here assuming, well, you're going to assume what we tell you is true. We believe it to be true. We've done research on this. We want you to have trust in what we say. But we're money managers. We can't misrepresent what we're actually doing here. But if you're not careful and you just look at some of the headlines that get pushed into your email, you can get trapped in a self-feeding cycle that confirms negative, incorrect information.
Correct. And there's so much information out there. Once you get online, it's really important to really, if you can, begin at the beginning and don't just vet the message. You need to vet the messenger. And you can start to see, oh yeah, these people are very biased and they put out a lot of information, but it tends to not be true. And then that can be the best shortcut to, hey, look at this headline, and then you see where it came from. It's like, oh yeah, okay, those people say a lot of things. It's just clickbait. It's never true. And so that's what is important, especially in this in the world of AI. People can put up things that look like photographs of what they're talking about. Here's the proof of what I just said. No, it's not. So you really need to back up a little bit and go back and look at the sources, and then take a wider view. Take a broader look across the internet, not just the places you usually get information, and see if other sources online agree with that or not. And you can get a little better idea of whether or not something is probably reliable or probably not reliable. And it's really important.
Well, it's really important, even when you're looking at the stock market, as let's say, especially when you're looking at stock market statistics. Sure. The end of August ended up with a down Friday. I mean, it was a big down Friday. We're closing out a month. There are a lot of things going on financially as far as market trading was concerned. Yep. And one of the assumptions over the weekend, particularly as we went into a 3-day weekend, was, well, that's just simply people selling because they realize that we're at a market top and the market is ready to go down. But what preceded that was an unusually positive day in the market, which if you took time to examine it, normally occurs at market bottoms. It's a positive sign for the market that is occurring at market tops. Well, why are people positive at market tops if that's the beginning of a bear market? Well, there is the fact that people are late to the game. Stock market investors are often wait until the very end of a bull market before they invest. But in fact, retail investors have been absent from the market. Now, they're never all gone, but the bulk of retail markets with enthusiasm and speculation, they're not there. In fact, when you look at the data, what you find is the financial advisors who service the retail sector are basically split on whether or not the positive trend of last month is the beginning of a new upward trend or
Right.
is in fact the end of a bull market that started post COVID. Well, we would argue that the dynamics that are going on in the market are a continuation of a market that should last for a long time, decades probably, as AI works its way through the 11 different sectors and the thousands of different companies that have an opportunity to upgrade their services and their products, many of whom will miss the boat. But
Right.
there will be companies that figure it out, and many of them you don't even know about yet. We don't know about them yet
Correct.
because their product hasn't been introduced yet.
Your point is spot on, Don. It really is going to be a very broad application and for AI across the board. And it's not important to pinpoint. Here's the AI company that's going to be most successful. It doesn't matter. There are lots of companies in lots of sectors that are going to be changed dramatically, have massive increased productivity, therefore better profits, better numbers, higher stock prices, and it's important to be participating in all of those and not just try to say, well, give me the AI company. What's the next NVIDIA that's going to make the huge run? That's less important than saying I need to be participating in this market, and there are going to be a lot of winners. Let's go find some of them and ride those for as long as we can.
Well, there are changes which we already see both companies doing well with and companies struggling with. But there's a couple sectors that come to mind, one of which is financials.
Yeah.
When we have new financial means of paying your bills, but that's one of the things that's really disrupted the major banks is that they were
Yes.
late addressing the fact that you could swipe your card. You've got the little box that you pay for bills, and you you don't even have to put your credit card in the slot anymore. I mean, you wipe it across the top. Well, this is changing that cryptocurrencies, not Bitcoin, but digital currency is going to change the way transactions occur and it's going to bypass the banks. Some of them are going to change and adapt, and some won't. Financing is different. I think a firm, AFIRM, comes to mind, where it's basically become an alternative to financing stuff that big companies used to use on uh, buy now, pay later. Okay,
Sure.
major retailers used to have their own buy now pay later systems. You'd come in, put it on layaway. That's the term I was thinking of. You put it on layaway, you come in and make your payments once a week or once a month, and you pick your product up. Now a firm now provides that. Other firms provide that besides a firm do the same thing. You look at utilities, which are a very deeply regulated business, but they're having to change how they operate and provide services. One, because it's AI driven demand, and two, how do they operate their company's transmission, keep track of the user base more efficiently. In our community, and I don't know about yours, but probably because you're in a bigger community than I am, the water company used to have to come out and pull the lid off and read the meter. Now they drive their truck by because the RFID system picks up our meter reading, and they don't even have to stop. They just drive by. Well, not everybody's doing that, but they'll be forced to do that just because the cost of labor gets too high. So the innovation of what's going on is not fully grasped in every industry, or certainly not by every firm, and not every firm has the capital to do anything about it. Correct. Those businesses, even if they're on the list on the stock exchange, run the risk of going out of business. They're going to be looking for an acquisition to take them out of business so they don't lose everything they already have. It's one of the reasons that we're running stock portfolios in addition to our exchange traded fund portfolios, because the stock portfolios can respond more quickly to companies that are innovating successfully and eliminating the ones that try and aren't making it. And
Correct.
whether you're using mutual funds or exchange traded funds in today's new AI industrial revolution, you are probably overly diversified to get the significant benefit from the companies that figure it out and get it right, come to market with it. And the public says, not only is that cool, that's essential. I really need that.
Right, and it's getting more and more that way. You read about the S&P 500 being top heavy, and when you dig a little deeper and you take a look at it and you figure out, well, there's only 10 stocks that are really making big money, and if the S&P doesn't quite have 500 right now, but if it did, there'd be 490 you probably wouldn't want to own. So just buying the S&P 500 by itself can get you over diversified. You can own too many firms that aren't doing very well, and it just waters down your returns so much that it actually increases your risk instead of decreasing it, because you're owning so many underperforming stocks in a group that large. So the market's becoming narrower and narrower. You need to be able to focus on that. That's one of the reasons we started picking stocks individually for a stock portfolio, because there are clear winners even now. And that's, like you said, Don, that's probably going to continue on for a number of decades as this whole AI revolution moves through our entire economic base.
Well, you mentioned that the stock market's becoming narrow, and that's certainly true. The S&P 500 does stay pretty close to 500 stocks, a little under, a little over.
Yeah.
But the NASDAQ has the same concentration problem. They've got the top 10 out of their 100 stocks. But you take a look at an index like the Wilshire 5000, you say, I don't know what it is. I'm going to own a little bit of everything. I'm going to own these 5,000 stocks.
Right.
Except there's only 4,000 stocks on the stock exchange.
Not 5,000 in there anymore. Yeah. So.
And the shift from mutual funds to exchange traded funds is gathering momentum as investors leave the mutual fund arena for less expensive exchange traded funds. There are now more ETFs on the stock exchange than there are individual stocks.
Yep.
And as that increases, basically the fee generation, high fees is the reason that that's the case, because the ETFs are becoming so highly concentrated. Many of the new ones only own one stock, and they own it with leverage. So you increase your risk by no diversification, right, and you multiply that risk because it's being done with borrowed money. Even if you haven't borrowed it, the fund has. So
it's in there.
You need a disciplined approach to how are you going to track the companies that are doing well and continue to do well, and the ones that don't. Do you have rules that are going to actually take them out of the game? Because, as you said, you own too many laggards in your portfolio, and it's a long-term problem for where you want to go in terms of achieving your goals.
That's absolutely right, and it's important to recognize that that's a significant shift in the structure of the market right now, of the New York Stock Exchange, of what's available to buy based here in the United States. Things are not the same as they used to be. Diversification rules that were formed over the last 75 years are not going to serve you as well as they have in the past because of the changes that are going on. It's important to recognize them. That doesn't mean that diversification no longer has a part. We don't think it's a good idea to identify a single stock and dump all your money into it because you think that's the single one that's going to be great. That's not the answer either. But owning a little bit of everything and hanging on for a long time is way off the charts now as far as being a good idea for your long-term economic health as far as investing goes.
So if you want to talk to us about any of our exchange traded funds or our new stock portfolios, these portfolios are not brand new like today. We've been running them for some time now. We have some track record to go with them. If you want to talk to us about those, our contact information is on the screen. Give us a call, send us an email. And if you like what you heard today, share it with others. If you haven't subscribed yet, do so you stay up to date with where we're going and what we're thinking. Thanks for being with us. Be sure to subscribe, and we'll be back in our normal cycle of publication. Have a great day.